welcome to the Mortgage Rate Weekly Market Update for the week of May 15th, 2017. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week, mortgage rates broke through floor of support. That's why we recommended locking the previous week because we were right at that floor of support. Instead of rallying off, we broke through it. Mortgage bonds sold off and interest rates did move higher. But there is a silver lining. If you go ahead and take a look at the bond chart on the screen, you can see what I'm talking about. Mortgage bonds broke below that support right there we were hoping would hold and they rally off of and fell all the way down to the next floor of support, which held on Thursday. And then you can see on Friday we were able to rally. Nice big green candle. So switch the momentum for the mortgage bonds to move up, which would move interest rates lower. And that was after a CPI inflation report came out. So with that green candle on Friday, you can see on the chart, we're going to recommend floating your mortgage rate to start the week to see if mortgage bonds can recover, continue this rally higher, and hopefully break back through that floor that was support before this now resistance and move interest rates slightly lower. So go ahead and float as we move into the week. In economic news, big report last week was retail sales report for April 2017. It showed retail sales rose 0.4%. and that was up from March's revised 0.1%. Now, increased consumer spending could signal a boost in the economic growth for the second quarter of 2017, so we'll keep an eye out on that because consumer spending makes up 2/3 of the economic activity for our economy. Then we saw a report on consumer inflation, which is the Consumer Price Index, or CPI, for April 2017. It was up 0.2%, and year over year the CPI dropped from 2.4% to 2.2%, which was bond-friendly news. That happened on Friday, and that's what spiked that big rally on Friday. The bond moved up with that green candle we saw earlier in the charts. We also saw a producer price index come out the day before. Now that came out a little bit higher than expected, so that was not bond-friendly news, but when the consumer price index came out on Friday, that helped mortgage bonds rebound. Then we saw weekly initial jobless claims come out on Thursday, and they dropped 2,000 claims to 236,000 claims for the week. Jobless claims numbers, the number of individuals filing for unemployment benefits for the first time. So that's a very great news on the labor market. We saw jobless claims just dropped again, well below the 300,000 threshold. So great news on the labor front. And then in housing news, the Census Bureau showed that 854,000 new owner households were formed. New homeowner households were formed during the first quarter of 2017 versus 365,000 new rental households for the first quarter. This is the first time in 10 years that there were more new home buyers than home renters. And that was according to Trulia. So seeing such a shift from home buying rather than renting is a very good sign for the housing market. And we also have very low inventory, so we've got a lot of buyers out there that want to be homeowners. So if we can get some inventory into the market, we'll see that number of home buyers spike up even more. So great news on housing. It's a great time to buy. This upward price pressure is going to keep moving home prices up. So if you're looking to buy, now is the time to buy versus waiting if you can find a home, because you will pay a higher price the longer you wait. And then in the local news, the next home buyer seminar is Saturday, June 17th in Newark, Delaware from 10 a.m. to noon at the Christiana Hilton Hotel. And the next one in Dover, Delaware is Saturday, June 24th from 10 a.m. to noon at the Dover Holiday Inn. Now you can register for either one of those seminars by giving us a call online. Give us a call at 302-703-0727 or register online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.